Joining me now on set is Nancy Tengler. She's CEO and Chief Investment Officer at Laffer Tengler Investments. Nancy, welcome. We're also joined by Barry Knapp, Managing Partner at Ironside's Macroeconomics, and he is taking no comfort from what the banks have reported so far. Welcome to both of you. Nancy, let me just start with you, kind of put this in context for us, earnings-wise. This is a tricky day as well, because this morning when Morgan Stanley was down 5%, it was an easier narrative than it is this afternoon as things are looking like they're stabilizing somewhat.
Yeah, I think this market has been much stronger than it has a right to be, but yet earnings were not nearly as bad as many expected. I know you have Brian Reynolds on a lot. He's done the tax work, and so he expected okay, not great, and that seems to be what we're getting. But I thought Sarah's interview with the CEO of PNC, don't call me a super regional or a regional bank, was really instructive, and that company did deliver better than expected across the board metrics. And so that's one of the names we own, and we'll probably be adding to it in here. And we've stayed away from the banks.
You know, and it's funny because on Friday we had the big, JP Morgan was way better than expected, but then PNC, a little concerned about that lower loan loss provision. They're lower, the regional bank stocks lower. And then today Western Alliance comes out and this is a very different story, and I'm sure it makes, by extension, a name like PNC, which seemed to be even better positioned, benefit from that.
Absolutely. And I think you're starting to see the managements like Goldman do what the technology companies have done. You know, they're focusing, they're honing their business models and their employment. That's good.
Yeah.
That's good for the stocks.
Well said. Barry, let me just turn to you. I don't know if you've dug into Morgan Stanley. It'd be unfair to put that on you. But why is it that up to this point you are not so impressed by what we've seen in some of the bank results?
Well, I think the big banks were beneficiaries of some regulatory policy back in 21, in particular when the Fed ended the exemption for cash and treasuries from the supplementary leverage ratio. And that meant that the big banks couldn't take in deposits at a point when the Treasury and Fed were injecting better than $3 trillion of liquidity of bank reserves into the system. And so as a consequence, they didn't wind up with that problem of what do we do with the cash in 2021, didn't buy as many treasuries and mortgage-backed securities as some of these smaller banks where the money did flow. And so now that credit is tightening, the money's coming into them and they're dealing with it. But my issue still is with the banks. And the last interview you gave was indicative of that, because he said, the analyst said that they're de-risking, right? So that means they're shrinking their balance sheet. This is the knock-on effects of credit tightening that's likely to permeate through small business generally and construction more specifically, right? Your interview with my old colleague Steve Kim yesterday, I thought was instructive, where Steve said 70% of the home building market, resi market that is small mom and pop type operations. Right. They're not going to get any capital for spec building. So, this is going to take 3 to 6 months really to manifest itself through the economy. But I think it'll show up in continuing of slower and softening labor income, and it will have a macroeconomic fallout. There's an obvious solution to it, which is the Fed ceases and desists on the rate hikes and may need to back off. But, they don't seem to be giving much inclination other than Austin Goolsbee in doing that.
Right, exactly. So against this backdrop, Nancy, and maybe we talk a little bit about this. Some of the names you're selling on strength are from what are perceived as relatively better parts of the market, some energy, some materials, that kind of thing. Adding Chipotle, adding to Tesla. Tesla reports tonight. Just give us some color around exactly how you want to be positioned here.
I think, you know that we've been adding risk back in since October and all of the fall, actually.
Which was the right call.
It was difficult, but it was the right call, at least for now. And then we actually have been trimming a number of those names, Microsoft, Salesforce. But I think when you are going into an economic slowdown or a recession, pick one, you want to own companies that have the ability to deliver reliable earnings growth. And I like the secular tailwind between old economy companies like Chipotle that are embracing the digital revolution, $1 million in sales per store digital. That's just the digital sales. And then the companies that are providing the arms, right? The digital armaments.